Well, welcome to our exclusive training where we're going to explore the art of making multiple offers to secure more deals in today's dynamic real estate market. And it's definitely a different market out there.
Welcome to REI Pro Talk, where real estate investors turn for the latest news, tips, and tricks from the real in the trenches pros. Tune in to hear Chris Goff, the nation's premier real estate investing powerhouse. Join up with other top pros in the investing world as they cover every topic. No fluff, no filler, no holds barred. All you need to know from start to paycheck.
Hey, I want to start this thing out because to me, this is the most important part of the presentation. I know it looks simple, sounds simple, but I'm telling you, this is the thought processes that I go through when I look at a property. When I talk to an owner of a property, this is exactly what I'm thinking because this right here is actually going to tell you what strategy is actually more probable that's going to work for the seller. It's understanding what we talk about is cash, and cash is just paying the seller in one lump sum. I don't care if it's your cash, bank's cash, private money's cash, hard money cash. When I say cash, we're talking about paying the seller in one lump sum. Whereas terms, how much down, how much a month, and how long can we do it for? If you think about it, if you own your own home, and you got financing, you didn't buy it for cash, you bought it on terms. If you finance a car, you bought it on terms. A lot of people use credit cards that don't pay it off at the end of the month. You're using terms. It's such a common thing. It's literally the American way, right? How much down, how much a month, and how long can I do it for, right? The ideal situation is to get a cash, what we call discount, meaning price, but being able to pay it on terms. So understanding all three financing techniques, at least to me, this is crucial for really detecting that seller motivation. And by mastering these techniques in conjunction with understanding the motivation, you're going to make more money in real estate, period. If the seller isn't motivated to sell under these three financing techniques, I don't want you to think about wholesale. I don't want you to think about seller finance. I'm just saying these three techniques, it's obviously not a deal that you could profit from. So when we talk about cash, it's got to be at a discount, right? We rarely buy things at full price when it comes to real estate, although we pay full price for so many other things in our life. These three right here, and I'm actually going to break it down and teach you exactly what strategies are going to apply to these. Then we're going to actually take those strategies and create offers. Then we're going to take those strategies and we're going to analyze how to profit with them. So if I get the property under contract with a cash offer, how do I make money? And how much do I make? If we get it under contract with a terms offer, how do we get rid of it? How do we make money with it? We're going to share all of that in this presentation. It's going to be pretty awesome. I created this neighborhood matrix chart that simplifies the most effective strategy for each type of neighborhood, along with the suitable financing technique. Having learned from I can tell you from my early mistakes, I developed this chart years ago to steer clear of misaligned strategies in the improper neighborhoods. And you can access this chart for free by visiting our membership tab in REIPro. This is just one of the many perks available to all of our REIPro members. And I know we have a lot of members on here, but I want to give you a test. And I just want you to tell me by only looking at the picture, I want you to say in your head, is this a potential cash deal where you got to get a discount? Could this potentially be a terms deal? How much down, how much a month, how long can we do it for? Or could this potentially be both? All right, so here's the first house. This is Eric's home in Austin. Just kidding. You guys don't even have trees like
It's a fixer-upper.
right? So I want you to think in your head, is this a cash deal at a discount? Could this be a terms deal? Or could it be both? And I know probably 90% of the people would say, oh, that's a cash deal, right? Because it's distressed. It needs a lot of work. Looks like you need to tear the place down, right? Maybe the lot's more valuable than the property, right? But I want you to think, couldn't you seller finance this home and then fix it up? but get it at a cash price, absolutely. And that's what this would be both. Here's my point. I don't want you to walk into a deal like this and say, "Oh, that's bad. That's wholesale. That's cheap." Like, I want you to think creative on terms as well. If that house that look, no one's lived in this house. This is kind of an extreme example, but you'll find these properties around, trust me. I want you to get used to thinking that this property is vacant. Somebody obviously it's damaged. Nobody can afford to fix it. It's been sitting there for years like this. Somebody could vandalize the property, somebody break in the property, somebody get hurt on the property. This owner has not been making money on this property, but yet they should be paying taxes, insurance, at least on this, or at minimum taxes. So it's costing people money. If nobody's touched this property for probably 5, 10 years, why don't I just get it on seller financing, get in cheap, make monthly payments, fix up the home and do something with it, or get it on seller finance, do something else with it. And I want you to think about that process because I just don't want you to think cash discount. What about this house? So, boarded up windows, right? But overall, it doesn't look too bad. Don't know what the inside looks like, but just looking at this, everyone on here should say both, right? Hey, we could potentially get a cash discount. It looks distressed, all the windows are boarded up, but you also could get terms on this. And we're going to explain in detail what strategies those are. So don't worry about that. But what about this house? So you drive by a home, check this out for rent. What do you think? Could you maybe get this at a cash discount? Possible. But the first thing that should come to your mind is terms because the owner is already willing to accept a monthly payment. Now the question really comes down to do they eventually want to sell it? If they do, then a lease option or seller finance could be a potential candidate. It doesn't mean that we can't put a cash offer in on this because you never know until you make the offer. So both, right? What about a foreclosure? Now there's two parts to this, and I'm going to break this down so simple. So prior to the auction is what we call the pre-foreclosure state. You could buy this property at a cash discount, assuming that there's enough equity in the property to do so. Most of the time, we're going to do what's called seller financing with this property. We're going to take over the existing loan. A lot of people call this sub two. And then we're going to just do whatever our exit strategy is, maybe fix up, resell, whatever that may be. So you could do both. But if this goes past the auction and if it's taken back by the bank, which then would become bank owned or REO, a bank isn't willing to take payments on it, right? They want to be cashed out. And that's what's going to happen. So in that particular instance, once it gets past the auction, it becomes bank owned. It would have to be cash at a discount. What about this house? Beautiful home, well kept. You can see the owner takes extreme pride in this property. What's the first thing that comes to your mind? It should be terms, right? Because what's the likelihood somebody would actually take a cash discount on this property? They seem like they've invested a bunch of money into this property. It's well kept. They don't want to take pennies on the dollar, right? So I would think and steer more towards the terms, and that's probably where I would initiate conversations is steering more to that side of it. Could they take a cash discount? Maybe. Probably not likely though. But I want you to start thinking of that just by visually looking at pictures because this is going to help you so much, I promise. I always want you to remember this. And those of you that watch my videos, you hear me say this anytime you're working a terms deal, seller finance, lease option, how much down, how much a month, how long can I do it for? I want you to think about this. If the seller picks the price, you pick the terms. So if the seller says, I want 500, great, I'll give you 500, but I'm going to give you 5,000 down. I'm going to pay you 3% interest, and I'm going to do a balloon for 5 years. That's the terms. If the seller picks the terms, you pick the price. Well, I want 100 grand down on that $500,000 house. Look, I'm happy to give you the 100 grand, but I'm not paying you 500. If the seller picks the terms and the price, they're not motivated. It's time to move on. Maybe follow up with them in time because there's only one thing that will ever change someone's mind. It's time. People's circumstances change in time. Chris, yesterday I wasn't in divorce, but I am today. Things change. People always sell based off of a situation. People don't wake up in the morning and say, I think I'm just going to sell the house today. No, people sell houses because They want to downsize, they want to upsize, they lost their job, they're getting a divorce, they're moving out of state, they're retiring. Whatever the situation is, that's the reason. That's part of understanding their motivation, which then helps us understand cash or terms, which then helps us understand what the heck is the strategy we're using. If you figure that out, that is the key to this business. Nobody ever talks about it either, ever. Now, you may say, why make multiple offers? I'm going to give you 6 really good reasons. The first one is options. So, by presenting multiple offers, investors can increase their chances of securing a deal that aligns closely with their investment criteria and meets the seller's needs. I can tell you this, I have had so many people like, no, I want this for it. And I make multiple offers, they end up taking something else. I'm going to tell you, when you give the owner options, number one, you look a lot smarter because nobody does it. And when you give people options, they feel like they have to take one because you're giving them multiple options instead of take it or leave it approach. That's the problem with most, I would say, wholesalers, because that's the way we were all taught. No, this is the price due to the amount of repairs, due to the time, your house is really bad shape, we can only pay this much. So they kind of shove a strategy down someone's throat. When I give multiple offers, multiple solutions to the problem, the sellers get so confused on which offer to take, they fail to realize they didn't have to take any of them. Negotiation. So when you submit several offers, we'll explain how to do this. It's going to give you that leverage. You could use the present alternative offers to negotiate better pricing, terms, and other concessions from the seller. Risk mitigation. Having multiple offers in play reduces the risk of missing on potential opportunities. I couldn't tell you that's huge. If you only know one strategy, then you're missing all the other opportunities out there, right? You don't know what you don't know. But when you have those strategies, you have the tools in the toolbox, and you can see these things happen in front of you. Building relationship, engaging with sellers through multiple offers demonstrates serious interest and a willingness to work towards an agreement you both can agree on. Maximizing your ROI. So, by casting a wider net with multiple offers, investors can increase their chance of finding properties that offer the best return on investment, optimizing their portfolio, overall financial performance. And the 6th one, and I could go more, but these are kind of the ones that stick to me. Adaptability. Making multiple offers allows investors to adapt to evolving market conditions. We have gone through the ups and downs over the last 4 or 5 years. Things have changed. You know, the one thing, Eric, that I tell people about real estate investing, it's always a good time to be in. And it's always a good time to be in. It's not, maybe not for that one strategy, but the market only dictates and changes the strategy I use based on what's happening in the market. A lot of people are like, oh, the prices are up, I can't buy low. Well, no, you just changed the strategy. They look at it a one way, like a one shoe fits all approach kind of business. And that's so wrong because
You're
there's
right.
so many ways to do something.
And I think one of the things on this, on why multiple offers, of all the things you said, I think one of the biggest ones is building relationships. Because if you can sit and talk with a client or a potential seller and you get to understand what's their motivation, and you can talk to them and you'll find out, are they really motivated or are they not so motivated? Maybe they are, but they don't know where to begin. And if you build that relationship with them and you come back with, it was great talking to you. So I've done some work and I'm going to give you 3 offers. And they're like, whoa, they're just kind of blown away. It's like, what do you mean 3 offers? But you know that from building that relationship to truly understand what kind of a situation is going on with them. And you can kind of tailor those options and those offers to them to try to fit exactly what they're trying to do. And even if they're not really sure, you can, and you're right, adaptability, you can tweak one of the offers. It's okay, we're going terms. You don't like those terms? Well, how about this? So it gives you more flexibility and more leeway to work with that potential client. And that just building a relationship goes a long way.
And I'll tell everyone, it's kind of something that I say, you don't ever think about teaching it until you talk about it. It's like, but I do this almost every single time I go look at a property. Every time I go look at a property, of course, building the relationship's huge. You know, we talk about that all the time, Eric, is how important that is. But when I leave the property, I usually go, let me go back, run some numbers. I like the home. I think I may have actually a few different ways to buy your home. And every single time the seller looks at me and just smiles like, oh, okay. And they have no idea what I'm talking about. Because when you make an offer on a home, it's only one offer. Right? So when I say I have multiple different ways of buying the home, they're like, "Oh my gosh, awesome." That I could tell you helps build trust. And when you have trust, you have so much. Even if the deal doesn't work out, that's the kind of relationship you wanted to build because they're going to tell somebody else. Or maybe it wasn't the right time for them to take those offers, but they're going to come back to you because they trust you. It's the hardest thing to build is that trust. And a lot of it is just the way you communicate. A lot of people always ask, what's kind of the favorite lead types to go find a property where you can make multiple offers? At the end of the day, it's pretty much everything. But these would be my favorite. Vacant properties for sure. Absentee owners for sure. I can tell you, last 3 deals we did in the last month were all tired landlords, by the way. Expired listings. You're going to start to see a lot more of the expired listings right now. There's been a slowdown in qualified buyer home sales type of deals, not investor deals. That's not what I'm talking about, but the qualified buyer on market listings that have been there for 60 days. Now, those 2 categories you can actually get from your local agent. Obviously, vacant properties, absentee owners, you can get an REIPro. Vacant land, you can get an REIPro. And I always say this about land. There's good and bad with land, but I always say this, they don't make any more of it. It's always probably going to be somewhat a good investment. Of course, you can apply all this to all commercial properties as well. So those of you more kind of in that commercial space, I could tell you we bought several commercial buildings and all of them were seller financing. I never go to the bank to buy a commercial building. It'd have to be something pretty big. Even when we did a 53 unit apartment complex, all seller financing. Eric, me and you almost bought a golf course on seller financing.
I know.
Yeah, see, I start thinking of things as you start talking about it. It's like, well, that was going to be a good deal, I think, but I don't know. We didn't buy it,
We
but
didn't.
we went and looked at it, talked to the owner, and actually it didn't work out, but it could have maybe.
Yeah, it
Oh
was
well.
just the numbers situation just wasn't quite right.
Yeah, that's why I always say fall in love with numbers, not houses, right? Too many people get emotionally invested in the house. They force themselves to do the deal by paying more than they realized later why they shouldn't have done that.
When you think about multiple offers, we've been taught and told when you buy a house, you make one offer. And
Yep.
we're in that mindset if you only make one offer because that's what we've been told to do. That's what everybody tells you to do. So coming up with multiple offers is kind of shifting the mindset a little bit because it doesn't have to be just one offer, even though we've lived our lives that way and we've heard about it and we've experienced it and we've done it. Now we're got to change the mindset a little bit and go, oh, wait, there are other ways of buying properties by, again, doing different offers. So it is
Exactly.
definitely information, a mindset change.
Which will actually lead us into our first offer, which would be that cash offer. So again, it's full payment, right? Doesn't have to be your cash. It could be of your cash. It may not be any of your cash. Maybe private money. It may be hard money. It may be bank financing. You're getting the full amount to the seller. Some advantages: quick closing, strong negotiation position, no financing contingencies unless you are getting financing. They may require approval, they may require an appraisal, they may require certain things that could add things to a contract that the seller may not like. Some disadvantages: obviously, you need to come up with a lot of capital, number one, or you got to have good credit to come up with the capital. And which then, if you have to spend a lot more for the money, if you're borrowing it, then it can lower your ROI. And as everyone knows, the cost of getting the money is super expensive, which is making it very difficult for you to buy a house and to rent it out. And cash flow, we're going to be talking about a little bit of that. And I want to say this because people usually ask this question. I'm going to give you the answer to it, but people usually ask this on my YouTube videos. So I just want to explain it just a little bit. Most sellers that you talk to, like somebody's put a house up for sale, they're going to want full price, right? They want full price and cash for the property, right? They don't want any contingencies. I want what I want. But in the real world, it doesn't always happen that way. I mean, I couldn't tell you how many times the seller wouldn't listen to anything other than a cash offer, period. And then I make multiple offers, they end up taking a different offer. Why? Because not every property commands the selling price envisioned by the seller. They don't see the problems out there. This is where your expertise is going to become invaluable. While some may consider renting as an alternative if the sale isn't immediate, many properties face challenges due to the high interest rates and mortgage payments surpassing rental income. This presents an opportunity I'm telling you to step in on. It's essential to remember that sellers, this is so important, typically communicate their wants rather than their needs. However, in instances where a seller remains firm on price without considering terms, you might as well just gracefully move on to the next deal, because that lack of willingness to negotiate indicates a lack of motivation to strike a good deal for both of you. And I want you to think about all of that, because not every house sells. A lot of homes go expired. A lot of people pull the houses off the market. A lot of people have to lower the price. Real estate comes in cycles. You never know what's going to happen sometimes with it. The next offer is going to be the seller financing. So the seller acts as the lender, providing financing to you as the buyer. This is where you're going to actually own the property. Some of the advantages: usually less capital upfront, flexible terms, lower interest rates, by the way, and potential tax benefits for the seller, because if they don't get paid in one lump sum, they're not going to have that huge capital gains tax. Add that to your sales pitch when you're talking about seller financing, is that they're not going to have to pay the capital gains on all that big chunk of money if they did take the cash offer. Some of the disadvantages: you may have to pay a higher sales price than your cash offer. And of course, if you fail to make the payments to the owner, they're going to foreclose on you. So there's that risk of default. Now, obviously, our goal is to structure these numbers correctly, number one, and have an exit strategy in place. And if this doesn't work, I could do this. If that doesn't work, I could do that. That is the best thing with seller finance. So you're going to have multiple ways. I'm going to show you exactly how to do that.
Piggyback on what you said on the potential tax benefits from the seller. That is huge, because when you sell a rental property, you're paying capital gains on that property. And that
Yep.
could be quite a bit. If you rent it out or actually do a seller finance, then that owner is getting a small portion, and it really doesn't trigger the big capital gains that you would normally get if you sold the property and you made $300,000. You're paying capital gains of $300,000, where otherwise you're paying capital gains on maybe $10,000 for rental income or whatever the case may be. So that makes a huge difference to the seller. And if you can, if you can understand that principle and then also add that into that, that's a huge little selling point that a lot of people don't take into account till they start paying their taxes. And they're like, why did I do this?
And even if you did like a 5-year balloon, like you always amortize over 30, I'm going to show you how to do it. Even if you do a 5-year, that balance is going to be a lot lower when you actually do pay off the seller. So
Exactly.
that's going to be a lower dollar amount of capital gain. So, and typically when you have this kind of income coming in, you have a business usually, or you may have potential other write-offs if it's not a business for you. This is the home run strategy everybody should focus on, every single state, by the way, which now leads me to lease options, which could be restricted in some states. If you cannot do a lease option, I'm not going to say yes or no. And what those are, obviously, Texas got some things. Maryland, you got to word things in a different way. But if you can't do a lease option in your state, then obviously this would not be one of your multiple offers. You would be in the cash seller finance offer. But if you could do lease options in your state, then all three could come into play in most cases. But I'm going to share with you. So what are we doing? We're leasing properties with the option to purchase at a later date. We'll then find somebody else to do the exact same thing with us. We stay in the middle and we profit from a house or a property that you don't own. You generally have no money invested in it. It's like, how many businesses do you know where you don't have to put any money into it and you actually get a return? This is the one right here, by the way. And if you live in one of those states, you could go find a vacation rental in a different state under a lease option, rent it out as a vacation rental. All right. I mean, there's a lot of things you could do. Some of the advantages, low initial investment, if any, because usually what I do is I take the buyer's down payment or what we call option fee and apply that to whatever I agreed to pay the seller. So ultimately, there's zero money out of my pocket. So this would be considered one of those zero money. Test property before buying, right? I can tell you a lot of people, hey, there's a lot of qualified buyers right now that refuse to go to a bank, pay 6.5, 7.5% interest, right? They would much rather rent the house, but live in the house that they want to live in today. As interest rates come down, hopefully over the next 12 months, guess what they do? They buy the house, but yet they're a qualified buyer. We always talk about lease options that we put buyers in there that are not qualified today. And yeah, that's true, right? Some people just need a little bit of time to get back on their feet. Maybe they lost their job as a temporary problem that they had that they need to get back on their feet. Who knows what that problem is? Of course, we do certain things, qualify, make sure they're going to be able to buy the house. That's the whole point of doing it. But at the end of the day, you're going to have qualified buyers right now that would do a lease option in a heartbeat because they don't want to make that high payment right now. Some of the disadvantages, obviously, you got to put an option fee. Could the market change? Meaning, could the value change of what you agreed to pay as a future price? Could that change? Of course, it could change. That's where you could always renegotiate things, right? But I could tell you, it's like you buy a car. This is a funny thing with this because people are always concerned about, well, I know, but what if the market goes down, Chris? What if it does? Then we address it at that point, go back to the owner and say, look, hey, the market's come down a little bit. Can we renegotiate this price? We're in a position to cash you out. I promise you, people are going to work with you on that. But it's so funny. We'll go buy a new car, right? Brand new car, drive it off the lot, lost 10 grand, but we're okay with that, right? That's okay, right? Because I've been in my new car. So obviously there's always advantages, disadvantages. I think it's understanding both sides of each strategy so you know how to apply it. Also helps us with our exit strategy. All right, so what I'm going to do now is actually go through a case study. We're going to be using REIPro to demonstrate the process of crafting offers, analyzing various exit strategies. And by exploring this case study, you're going to gain valuable insights into making informed decisions and evaluating your exit options in multiple different perspectives. So here's the case study. I'm not going to give you a ton of information, but I will pull the property up. Number one, this is a vacant property that I'm going to pull up. This property, we marketed it through a postcard. This is a postcard we actually use in REIPro. It's under our general category. It's postcard number 3 for those of you that are REIPro members. That's the postcard that this property. It's a tired landlord. I'm telling you, we're finding a lot of tired landlords. He would not give an asking price no matter what. He wants you to make me an offer type of guy. And they're out there, right? But this property, very minor repairs. I've got a property saved. I'm actually in what we call executable step number 4, which is running comps, making offers. That's where we are. So step 1, for those of you not familiar, is we literally walk you through the entire buying, selling process, finding the deal, talking to the owner with the phone script, property inspection. We're to this point. Now, REIPro has comps in all states. Okay, so all MLS comps and as well as public recorded comps. So any kind of for sale by owner, things of that nature, we're going to have. So anything recorded as well as the MLS, we're going to have. And this would include all non-disclosure states, by the way. So those of you that live in Texas, that it's illegal to publish sold data on a public website, this is where you would go to get that data. So we have that. I'm not going to go through the comps, how I did this, but just know that I've actually ran the comps on this. And the very first offer that we're talking about is making a cash offer. Now, we have a little switcher here from wholesaling to rehabbing. If you're not a wholesaler, then we would just remove the wholesaling fee. Maybe you're the one looking to buy the property and rehab the house. That's totally fine. I'm just going to use wholesaling as the example here. So we have our after repaired value of $269. As you go through here, there's explanations on what these costs are. This is my cash offer formula. I've been using it since 1999. It's a mathematical equation. It's not take 70% of the ARV, back this out, add 2% minus 1,000, and you come to your offer. Some crazy formula people come up with and do a YouTube video on. This is a mathematical equation, actually, because if your offer is wrong, guess what? You're in trouble. You better make sure these numbers are correct. So acquisition cost is going to be the closing cost to actually acquire the property. This property, it really needs updating. It doesn't need like major rehab stuff. I call these properties that need like lipstick. But here's the thing with this property. Somebody could actually move into it tomorrow. If somebody can move in the property, that means that the lease option strategy is now on the table, because with lease options, we're leasing a property with the option to buy. You don't, this is a general rule of thumb that I always tell my students, is that you don't want to lease option a property that you have to put a bunch of money into. Here's why. You don't own it. Don't put money, a bunch of money. If you need to, go clean the carpets, get the yard cleaned and spend $500, that's different. Do not go spend tens of thousands of dollars to invest into a lease option when you don't own it. Huge mistake. Always add what's called a hedge expense, which is, I like to use it's a 10% rule for me. And that's 10% of the repair estimate. This is going to cover that leaky pipe you didn't check when you inspected the house because the water was off. It's those hidden things that you didn't see. So I'd like to add a little bit of buffer. Holding cost, which wouldn't be all that high for this particular property, while we're fixing it or putting it in a position to do something with, which at this point we don't know. But if I did a lease option with the owner, I would lease option it back out. So usually that's my exit strategy. I don't know yet because this is a cash offer, right? So I have to put in the agent commission. Okay. I may not use an agent. If you know that you're going to buy the house at a discount, rehab the house, and put it on the market and sell it yourself, you don't need an agent commission unless the buyer brings one, right? So that could be negotiated. I don't care if you buy a home. This is a huge mistake. I'm just going to bring this up. It kind of has something to do with this is what investors do, Eric. They go buy a home. They don't calculate the full cost of rehab compared to the ARV. What they do is they go, oh, no, I could put $5,000 in this thing and rent it out right now. That's what they do, right?
Yeah.
So they only calculate the 5 instead of the 25. They don't think about the selling, because at some point, I don't care if you rent it out for 12 months or you rent it out for 12 years. At some point, you're going to have to fix up the house when you sell it, unless you're going to sell it as is and take a discount on it because it's not going to be in great shape. If you don't account for the cost of selling it before you make the offer, you're already going to lose money down the road.
Correct.
People don't cash flow enough money to make up 25 grand. When you decide to sell it in some future date, you're going to have to come up with that money. Now, is your debt lower? Absolutely. But people don't consider that. What they do is they say, well, it could be appreciate. I'm going to go based off the appreciation value, which you don't know what it really is. We could take guesstimates of what that's going to be, but you have to include that cost up front. If you don't, you pay too much for it. Closing costs. So when you do eventually sell it, I don't care if you sell it in a month, if you rehab and sell it, or if you hold it and rent it out for 10 years. At some point, you're going to sell it. You're going to have closing costs. When I add those up, those are what I call my expenses. Now I just need to add in my profits, because at this point I'd break even without adding any profits in there. So I have my wholesaling fee here. I only did 2.5%. Of course, I'd like to make as much as possible if I'm wholesaling the property. And then a rehabber's profit, I just put in 12.5. Usually I try to stay around the 15% mark, but each property is going to be a little bit different. When I add those profits in, we calculate exactly what your maximum cash offer is, which will be 182. That's 67.8% of the ARV. Our recommended, I like to start 2% less than that as a general rule. And then I actually take it down just a little bit more. And I always end the last three in 870, by the way. It's been a very good luck charm number for me. That's the only reason I do it. And why isn't it 180? Because if you make an offer of 180, it doesn't look like you put much thought into, I'll just give you 180. If you go and you say, I can offer you 178,870, the seller's going to go, there must be a reason why they came up with that weird number, right? Like you
Chris,
actually took the
that
time.
is so true. That is so true. I've done this 4 times now and thrown a weird number in there at the end, like 249 or 237. And people are like, what in the world? And every time I've done that, they've taken the offer. I'm just like, okay.
Yeah, you got to make it look weird because I could tell you, even just running mathematical numbers, it's never going to come out even. If you
No,
actually just follow the numbers, it would never come out even because nothing's ever rounded that way in expenses. So should look funny, but knowing that I could go up to 182,766. Okay. If you're the rehabber, you could obviously add more rehabber's profit because you're not going to have a wholesaler involved in this transaction. Now we're going to also make a seller finance offer. So I want you to catch this. And this, if you're going to write down something or try to remember something, this is the part I would actually remember. When it comes to offering as far as the sales price, because that's what sellers look at, right? That's the number one figure every seller looks at is how much are you buying it for? My cash offer sales price, which that's all there is always going to be the lowest number. Next up is my sales price for my seller finance, which I could technically offer them more if I feel that it's going to be more appealing, more attractive to the owner to ultimately pay more than my cash offer. But like I said, we got to get it on terms. How much down, how much a month, how long can we do this for? If they're open to the terms, then I can pay a little bit more. So that's my general rule. And then if it's a lease option, the sales price will always be the highest. You can't go into a deal with multiple offers and say, I'm going to pay you 100 and let's say 80 grand, or I can give you 180 grand with 10 grand down at 4% interest. Well, why would they do that? Right? Unless they just wanted to invest their money back in, because you think about if they took the cash offer, a lot of people don't think about this. If I gave the owner 178,000, let's say they own the house free and clear because this house is actually owned free and clear. Let's say they took the 178,000. What are they going to do with 178 grand? They're going to put it in their checking account. It's just going to sit there. If they kept it invested into the property, they'd be making 4% interest off me just by doing the seller finance, which ultimately, as you know, the banks always have the biggest buildings. It's because they make interest off of all of us that get financing. So the seller is going to be making that. So they're not actually getting the 225. If they're willing to do that for this particular deal, I could go 10 grand. I could even go 20 grand down on this house because it really is a good property. I want you to think about if you get the owner to finance the deal to you, how many $250,000 houses can you buy for 10 grand? You can't. You can't even go to the bank and do that. I'm going to offer a 4% interest. Remember, there's no loan on this house, but let's say there was a loan for a second. Of course, this could change our interest rate because the owner may have a different interest rate than this. But if you go back between the years of 2019 to 21, those are the years of the lowest interest rates. So what I like to do is go into REIPro, go over to LeadPro over here, and actually search for properties, use the filtering to narrow down when those properties were actually sold last. And I can cherry pick absentee owners. I can cherry pick vacant properties based on when they were last purchased, and which is only a few years. So you get somebody that's got a 3% interest rate or 3.5% interest rate. They're more likely to take a 4.5, or even 5% interest rate when you make the offer. This particular gentleman doesn't have a loan. And that's why I like to try to get it. I don't want to look stupid and go in at 2.5% because it's never in history it's been 2.5%. And I look like I'm taking advantage of someone. I want to make it somewhat, legit here. I always amortize a loan over 30 years in order to keep the monthly payment down. Always like 5-year balloon, but if you can go 10 years, you go 20 years, you go 30 years, the full length of the loan, then go that long distance. Longer the better on that. I'm just using 5 as an example. So what that means, I can go over a show amortization chart. In 5 years, I go down to the very 60th payment. I would owe the owner 194,000, meaning that I would need to refinance it, or I could sell the property for whatever it's worth at that time if I chose to do that. But if I wanted to hold on to this property longer, I have to cash the owner out at 194, which is much better than cashing the owner out if they sold it for 225. Obviously, we own the house. We got to calculate the taxes, insurance on this as well. There's no additional bank fees. There's no points. You don't have any of that mess when you get the owner to finance it. We do the big breakdown here. And what I want you to look at is if the owner took this deal, and sometimes we've got to negotiate this a little bit, they would make, look at the second to the last number here. They would make 41,000 just in interest just by saying yes to us, meaning they would make an extra 41 grand. So they're going to get paid 266, not the 225. Now, of course, this is over a period of 5 years. Now, for me as the investor, if I own the property and I have a low monthly payment, this opens up so many exit strategies, which we're going to go over in just a second. Last but not least is our lease option offer. As I mentioned, now we're close to the ARV already. So I usually like to make this look very attractive to the owner. And I hear you, we're going from 250, 225 to 180, but that's how they work. That's how multiple offers should work. Some of those numbers could change a little bit. I'm going to go 3,000 down, 1,400 a month. I know that it rents for 1,700 a month. They're around that. And I like to make at minimum $200 a month positive cash flow. So I offer 14 over here, then I can rent it out for 1,700 or just shy of that. But I want to be close at minimum 200. In this case, I could go to 300. I want to get some monthly credit. So if I pay you on time, I'm going to get what's called a monthly credit of $250. This is just the paper credit. It's only applied to the purchase price when you buy. It's not a savings account. The seller saves the money for you. I'm going to try to go 24 months. I do always remind the seller that we will try to cash you out as soon as possible. Because when I put this out on a lease option as my exit strategy, I'm only going to go 12 months. If they can't buy or something changes in their life, then I have another 12 months to do something with the property. I always pay the first $500 in maintenance cost and repairs. I'll carry that over to the buyer so it's not me personally making those payments. Or, toilets break, light bulbs go out, air conditioners go out, things of that nature are going to happen. But keep in mind, it's just a lease with the option to buy. The owner still owns the property. They still have insurance on the property. If the owner has a $500 deductible, if something major went out, the buyer, tenant buyer, is responsible for the first 500 per occurrence. So it's really no money out of the owner's pocket, which is very attractive. There's my multiple offers. And what do? We basically you could view, print these right out of REIPro. You could do it in PDF or Word doc. We actually have some lingo, the language that you need in here. But if you do download it in a DOC, you could always edit the language. You can upload your custom letters and stuff like that. You can always email the offers as well. I'm here to tell you the most important part about presenting these offers, all three of them, exact same time, is to print them out or email them. It has to be on paper. Sellers don't understand everything you're talking about. Otherwise, they'd already be doing it. So they need to see the numbers spelled out and how the breakdown is. When they see that, it's way more, they comprehend it a lot better. And I think any normal person would actually, right? Because if you're not familiar with the strategies, like I may have already lost you at this point. Okay. But we do have a huge education center. We'll walk you through all this strategies. Now,
This
here's the key. I make all three offers, Eric. Guess what? Which one are you going to take? And but this is very important. And I think I only teach my coaching students these, like, because we have these private conversations. If you talk to an owner that only wants cash, I still present these other offers. And here's how I do it. Exactly how I do it. Almost exactly. It depends on the person I'm talking to, but I go to the seller, say, look, I've come up with three offers. I understand you only wanted a cash offer, but I wanted to present these other two offers while I'm calculating all the numbers. I know it's not exactly what you want to do, but I thought I'd present it to you because I can actually pay more money. And every single time they look at them. Now, the cash offer, they could be sticker shocked, depending on the property, right? But it only makes your other offers look better. It at minimum makes you look like you put forth the effort, which is going to help build the trust. Because if a seller says, look, Chris, I really need to get to this price. Well, if I can pay monthly payments and get close to the price you want, or maybe even more, would you be open to that? If you can just kind of talk that way to people, I promise you, you're going to do more deals, period.
this is really important because a lot of sellers that I've dealt with are generally they've had the properties for a while. They're not 25-year-olds. They're
Exactly. I
40
was
and
just
50
thinking
and
that too.
60-year-olds, and they want to see the numbers. They've been doing it for a while. They've been renting for a while, whatever the case may be. You're dealing with, I'd say, generally an older population, not 20-year-olds. So they're going to want to see numbers. And if you show them numbers on a piece of paper, then they can go through and they can do line item analysis. And it makes a lot more sense to them. Plus, you can explain
Totally.
the
Yep.
process too, and why you came up with the numbers and your explanation as to why you came up with those numbers. So it's one thing to offer them, but you have to also understand why are you offering it, and you have to understand the numbers so you can explain the numbers to them when they ask questions. So it's good to practice this a couple times, but also go through these offers like Chris is showing you on the software and really kind of just take some different examples and just run the numbers on them. And then after doing it a few times, you'll go, oh, I got it. Now I see where you got those numbers. This makes a lot more sense.
Yeah, if you understand the numbers, I think the strategy comes into play. It's just funny. One of my older students, 71 years old, it's a property in Georgia. And I actually looked at it with my student. I haven't been teaching him but a couple of weeks. Like, he didn't know anything about these strategies other than just the typical what we're kind of taught, right? And we go see this property, and the mother had passed away. The father was already passed away. The mother passed away and left the property to her three sons. And we met one of the sons at the property. And we go through this property, and my student, 71 years old, he's walking around like, oh, we got to paint the walls. We got to do this. He's just like, no fear whatsoever. So we crafted multiple offers, but knowing they just wanted to what? Get their money out of it. Their mom just passed on. They don't want the property. They just wanted to take the money, split it between the three of them, and move on. But what did we do? We made multiple offers. So we made a cash offer, made a seller finance offer, and made a lease option offer. And we made all three offers to the son that showed us the property. He said, let me get with my brothers and I'll call you back. That's how he said it. Okay. A day goes by, he calls back, calls my student. Remember, he's been in it for 2 weeks. And he said, I talked to my brothers and we're going to go with the lease option offer. But what is it? My student said, oh, you know what it is. It's just a lease agreement with the option to buy. Like, he didn't even know. He's like, oh, okay. I was just making sure, we like this offer. The cash offer was too low, but the lease option offer, we wanted to get cashed out in the next couple of years. We didn't want to wait 5 years. We don't care what offer they take because we're going to analyze it right now. on exactly our exit strategy. So if you go to Deal Pro, which is right here in step 4, I've already ran all the numbers just to shortcut this because I know we're going over in time. But on the left-hand side, I said purchase. So I know that's going to be a cash deal, right? I don't care if you're wholesaling it. I don't care if you're rehabbing it, whatever you're doing. Purchasing the property, we're going to pay the seller in one lump sum. I added all the numbers in exactly how we did the cash offer. Now, if you're getting financing, you could change this and add that information in. On the right-hand side, if we buy the house, we could sell it and flip it. We could rent it. We could lease option it, or we could sell or finance it. You have multiple exit strategies when you own the house. So in this example, we're going to rehab the house. I put in my ARV 270. That's what we ran. We're going to do estimated months to sell was 1. I did add in the real estate commission because we calculated that. And that's assuming we use a realtor. This would be my total profit if I bought it with cash, fixed it up, and sold it. But now I can also go back and say, what happens if I bought it and rented it? So now I can look at a different exit strategy. So I would go in, my numbers on the left are the exact same. I could go in and actually do this, go through the numbers, and actually get what my return is going to be on the property. I also went in and just did a lease option because if the owner takes the lease option offer, I put in my lease option terms over here that we bought it for. I put in my lease option terms, so we're going to sell it to a new buyer. And then I can calculate the costs and what my profit would be if I did that on a lease option. And then I did one more for you. And again, you could do this in so many different ways. What if I seller financed it and rented it? I go through the exact same numbers. I did not put in the repair cost here because this house is ready to go right now. The numbers wouldn't work because if I rehab the house, I'd have to get it at the lower dollar amount to do it. But because I'm paying $225, paying more than the cash offer, I can't necessarily put in the repairs today, but at least I can acquire the property. Now, the cash flow is not good, but I want you to remember that, this wouldn't necessarily be the best exit strategy for this property based on these numbers. So I wanted to show you, that you have to analyze. I know over in my cash offer seller, that's what I can offer. Okay. Over here in Deal Pro, we're analyzing how we can make money from that. So you get the full analysis just by going in here and running the numbers. And of course, we have training videos if you're totally confused. It's okay. Right? We can teach you this. Okay. And it's all included for free. There's no upsells in here as far as education and all that. It's all included. So learn these strategies, super duper important. Kind of recap and some tips here. I want you to start applying these strategies to that next deal. Now, like I said, if the property's not livable, you can't put a lease option in. Of course, if you're in the state where you can't do a lease option, you can't do that either. But 2 offers is better than 1. Think about this for a second. I want you to think about the seller finance for a second. This would also apply to the lease option. You remember when I said the seller picks the price, you pick the terms. Seller picks the terms, you pick the price. How many seller finance offers could I actually make on this property? Now, I could pay you $225 with 10 down, or I could pay you $245 with nothing down. Maybe I go lower interest. Maybe I go longer term. Maybe I go shorter term, but give you something over here. You always should be qualifying the seller and understanding what I call their pet peeves are. And pet peeves are they focus more on the price, they focus more on the down, they focus more on the monthly payment. What is it? Or maybe is it the term? They don't want to go that long. Maybe they do want to go long. If you can start to take that information right there, whatever the seller's telling you, and it may prompt you to ask some questions, it's going to help you craft a much better offer. When I make an offer to someone, if it's 1 or 3, I try to make it one of my best offers based on the home, the location, the situation of the owner, Some people say, well, no, I want cash, but at the end of the day, what happens if it doesn't sell? What are you going to do? And when you ask that to sellers, you wouldn't say it exactly the way that I just said it to you, but have you thought about what you would do with the property if it doesn't sell? That's exactly what I say to people. And you know what people do? Um, well, we think it's going to sell. Well, I understand, but if it doesn't sell, what would you do with it? Well, we would probably stay here. Number one, that could be an answer. Number two could be, well, I guess we'd have to rent it because we have to go to Utah because I've got to take care of my mom. That's why I offered you the lease option. That may be a great solution of way of selling it. And even if they say no to all three, follow back up. Because like I said, time will change a lot of people's motivations. Keep in mind, two ways to buy: discount or terms. Don't even think of strategy, because if you know if it's discount or terms or both, you're going to understand what strategies will apply to that deal and master each strategy. We have full training series on every single one of those strategies inside of REIPro. No additional cost, by the way. Use Deal Pro. Analyze that exit strategy. Because if you think you're going to go in there and sell or finance, oh, I can make $500-600 positive cash flow. Guess what? You can't. It's not going to happen. I didn't even put the repair costs and it doesn't work. So make sure you run the numbers. Calculator's a lot smarter than all of us. These are going to be the next steps. If you're not an REIPro member, you can sign up for a free trial. Start analyzing deals. Obviously, we're going to walk through REIPro's kind of that more complete system. It's going to give you everything. We've had a lot of people, so I thought I would just address it very quickly. I don't want to take up your time. But if you're interested in working exclusively with me to master the real estate investing business, this could be the perfect opportunity for you. I'm going to tell you, many people have asked, so here's the answer. You don't even know the question, but you're going to know the question as soon as I give you the answer. I work one-on-one through private calls, emails, and Zoom meetings. I don't conduct group sessions, nor do I employ paid coaches. If you're seeking a personal coaching program, then this is it. If you want to learn more, go to my website. There it is right there, chrisgoffrealestate.com. Click on coaching, fill out the form, and schedule a free 30-minute call with me. Okay, this call is just between you and me, allowing us to see if we're even a good fit. Number one, you need to know that I'm the right guy for you. And number two, I also need to make sure that you are the right student too. I take very limited people. Eric knows this, easy for me to say, but I do not take a lot of people because I work with every single one of my students on a personal level. So if that's something you're interested in, feel free, go to the coaching, schedule a call with me. You'll see my available times once you do that. Thanks for joining us on this training, and we hope you found it insightful, valuable, and be sure to follow me: YouTube, Facebook, Instagram, TikTok. And don't forget to explore REIPro. Start making those multiple offers with confidence, and happy investing to you. Now,